Hello, my dear students. Good morning. This is Susiraj from Ravilla KRA Vidyashram Matriculation Higher Secondary School. In your commerce, chapter number 4, it's talk about the financial markets. So, in the last section, you learned the meaning and definition of financial markets, concept of financial market, scope of financial market, and the different types of financial markets. So today you are going to learn the role of financial market, functions of financial market, the difference between the new issue market and the secondary market, and the classification of financial assets. So look at the first topic, role of financial markets. A world without the finance, how it is possible? A world without the finance, how it will run? Can you please imagine everyone we are living in the modern world without the banks, stock markets, currency markets, whether we are able to survive in this world? No, it is not possible. Yes or no? So here the depository institution are accepting the deposits from the lenders or the savers, the surplus units to provide the funds to the deficit units or the borrowers or the institution, the creditors. Yes or no? So the depository institution accept the deposit from the surplus units and provide the credit to the deficit units. That is the major role. Then the second one, it is focusing on the improvement in technology and its impact on the how the financial products are delivered to the companies and the investors. Then a financial market on its a great use for the country. It helps the economic savings and mobilization. How the financial institution or the banks they are get or they are collecting the funds from the general public, how they are accepting the surplus units from the households, business firms, and public sector government. So this is the major important role play in the financial markets. Okay, then the second one, investment. The people they are investing the money into the bank and the financial institution. So the companies and all governments they are borrowing and they are investing in the different aspects. Have you understood? So the financial market is play a key role in arranging the investment of funds those collected in those units which are needed to the same aspect. Then the next one, national growth. So look at here, the economic growth is increasing in the production of goods and services in our economy, increasing in the capital of goods and labor force, technology and human capital can be contribute to the our economic growth. At the same time, in the financial markets, it's also contribute the nation's growth. It ensuring an unfettered flow of surpluses funds to the deficit funds. So lender is having the surplus fund, and one another aspect is the borrowers they want the funds, they require the funds. Yes or no? They don't have the enough funds, adequate fund to develop their organization or their industry. They want to expand their business operation. That's why they are requiring the funds. So here in this concept, the funds are transferred from lender to the borrowers. In that way, they are able to fulfill their labor force and technology in the industry. Okay, so in that way it leads to the overall economic growth. Then next point, entrepreneurship growth. So what is that entrepreneurship growth? So who is called as a entrepreneur or entrepreneurship? The person who established the business, one who owns, one who start the business venture, that person we called as a entrepreneur. Yes or no? So here the entrepreneur is generate the employment opportunities to the many people besides providing the self industrial development. The industrial development is nothing but it's building and growing of industries within an economy. These are the industries are include the mass production and technological advances and other services. Yes or no? So here the different components of financial market, it helps the accelerated growth of the industrial and economic development of a country. It's contributing and to raising the standard of living of the society and well-being. That is the industrial development. Thus, forming the capital, the capital formulation, and providing the short-term and long-term credit to the individual or businesses and the organizations, and creation of employment generation and development of financial market in different angles and attracting the foreign grants. These are the major roles of the financial market. Then move to the next concept, functions of financial markets. So in our financial market, it's classified two different functions. First one is the intermediary function and another one is the financial function. So what is the intermediary function? Is nothing but its transfer of resources, enhancing the income, productive usage, capital formation and price determination, information regarding the financial market. These all called as the intermediary functions. So look at here, Mr. X, he purchased the shares from the XYZ Limited company. He purchased the shares. Now he is holding the 500 shares at the rate of 50 per share. So totally how many shares is he having? 5,000 shares he is having. Yes or no? So 500 shares at the rate of the 50 per share. So total shares value is having, total number of shares is having 5,000 shares. And you need to liquidate that shares. You need to convert as a cash. So he is going for mistakes, he is located the fund. That's why he is going for two aspects in the liquidation functions. One is with liquidity function and another one is the no liquidity function. The with liquidity function, he is able to easily, he can buy and sell his securities. So he is able to sell his shares and he is converted as a cash. But here in the no liquidity function, it is very difficult to buy and sell the securities. It is not easy way to convert the funds, convert the cash or the liquid. Okay, then the next one, transfer of resources. In the first point in the intermediary function, transfer of resources. So here is nothing but our financial market, it facilitates the transfer of real economic resources from the lender to the ultimate borrowers. So one side, the people, those who are having the surplus units of funds, they are going to transfer to the borrowers. The borrowers, they are invest in the business and they are developing. Yes or no? That is called as a transfer of resources. The next one, enhancing income. So here the enhancing income, the financial market allows the lenders to earn the interest and the dividend. Okay, it's nothing but there are two aspects. I told you already. As a general public, myself, I'm investing the money into the bank. Later on, after some period, the bank is giving the interest to me. Yes or no? They are providing the interest to me. And the different angle you can think how the bank is earning the money. So the borrowers, like a individual person or the organization or the company, they borrowed the money from the bank or the financial institution. Later on, after some period, the bank is charging high rate of interest from the borrowers. In that way, the bank is earning the income. Yes or no? So that's what I mentioned here. The financial market allows the lenders earn the interest and the dividend on their surplus investable funds, okay, to contributing to enhancement of the individual and the national income. Through that way, they are contributing the national income. Then the next one, productive usage. What is that productive usage? Is nothing but the financial market allows for the productive use of the funds borrowed and this enhancing the income and grass. So let's say for example, we can say like that electricity, heat and mechanical powers we are using in very productive manner. So it helps the growing of our national income. Then the next one, capital formation. Financial market provide a channel through which new savings flow to aid the capital formation of our country. So it creates the new form of the savings flow, okay, to form a capital. So that is called as a capital formation. The next one, the price determination. In the financial market, it allows to determine the price it's traded in the financial assets. The interaction between the buyer and the seller, the two people, they can decide the price. They can sell the securities, they can trade it in the financial markets. Okay. Then the next one, sales mechanism. It's nothing but the financial market. It's provide the sales mechanism, selling of financial assets like bonds, debentures, securities. Okay, so these all easily you can sell, and you can easily you can liquidity of such kind of assets. Easily you can convert as a cash. Okay, then the information, the financial market activities, these are participant in the financial market results in generating and consequences dimensions of the information various segments of markets as they reduce the cost of transaction in the financial asset. If you want to sell in that sector, you need to spend lot of money. So in the financial markets, it's give the major information about that. You are able to reduce the cost of transaction of financial assets. Okay, then the next one, financial functions. So here the financial functions are price determination, fund mobilization, liquidity and risk sharing, easy access, reduction in the transaction cost, capital formation. So here the financial functions are providing the borrowers with the funds so as to enable them to carry out their investment plan. So once they borrowed, the borrowers, if they borrowed the money from the financial markets, the bank and financial institution, they are able to carry with them the investment plan, how to invest. They know how much they are going to borrow, what is their plan, how they are going to utilize that money, yes or no. So they have the proper plan. Okay, the investment plan. Then the next one, the providing the lenders with earning the assets so as to enable them to earn the wealth by deploying the assets in productive ventures. They are providing the liquidity in the market so as to facilitate the trading of funds. The difference between the new issue market and the secondary market, or we can say, we can call the primary market versus secondary market. The first one, meaning of the primary market and the secondary market. The meaning, the marketplace for the new shares is called as the primary market, where they are offering the securities for the first time or initial issues. Okay, that place we called as the primary market. Okay, that is called as the primary market. The primary market is nothing but where they are offering the securities for the first time, that is called as the primary market. The secondary market, the place where they issued the securities, already they issued the securities or traded, is known as the secondary market. The resale market we called as the secondary market, or we can say offers trading of already issued securities. They already issued the securities, that is called as a secondary market. Then another name of the primary market we can call as the new issue market. So another name of the secondary market we can say resale market or aftermarket or share market. Then the type of product. Here the primary market, it mainly include the two types of the product. One is the IPO. The IPO, it's nothing but the initial public offering. So where they are issuing the first time, they are issuing the securities, that the stocks, debentures, that all, where they are the shares, where they are issuing from the private company to the public. Okay, here stocks of the private companies is offered to the general public, that is called as the IPO. Then FPO is nothing but the follow on the public offer. Follow on public offer, it is nothing that issues new shares to the investors or the existing shareholders. Okay, you are giving to the investors or the existing shareholders. You are issuing the first time. Okay, that is called as the follow on public offer. Then the next one, here the type of product in the secondary market, shares, warranties, derivatives, and the more securities they are traded in secondary market. So it is called as a resale market. Then the purchase type, here they are purchased directly, they are purchasing, but in the secondary market indirect purchase. Okay, so here the direct purchase is from the company, you are able to directly, you can purchase the new issues, new stocks. Okay, but in the secondary market they traded already, so you're going to purchase the what they issued in the market, the securities already they issued, in that only you are able to purchase. So that is the trading between the investor. Then the next one, frequency of selling, only one time they are selling in the primary market. Here multiple times you can buy and you can sold the securities. Then the next one, parties involved, how many parties they are involved in the primary market. Company and the investor they are involving in the primary market, but in the secondary market it is already they resell the securities, yes or no. So that's why the investor buy and sell among themselves. Okay, then the beneficiary person in the primary market company, and the secondary market the beneficiary person is investor. Then how to identify the investment, here the investors primarily rely on the prospects and the word of the mouth or publicity. They are believing the prospect what they give from the company, what they give the information, it already it's displayed, they gave all the details they gave in the prospects. And one more thing is they believe the word of mouth publicity. Okay, but in the secondary market it's not like that. There are several tools such as the price to earning and price to book and price to sale and more things are there. Okay, with the help of that they are identifying, and after that they are investing their money. Then the next one, intermediary. In the primary market the intermediary is the underwriters. Who is the underwriters? The bank and other financial institutions that pledge to buy all the unsold shares in and the issues of the new shares. Okay, a process of arising and selecting the underwriters, a process of assessing and selecting the risks and determining the premium, and the terms and conditions are based on that. Okay, that is the underwriters. Then here in the secondary market the brokers, who is called as a broker? A dealer or the agent, yes or no? A person who buys and sells the goods or assets for others, that person we called as a broker. Okay, so in the secondary market already they traded, someone the investor already he purchased or he bought that one, after that he is selling, he is reselling some other investor, yes or no, that is called as a, that person we called as a broker. Then the next one, purpose. The primary market the main purpose is to raise the capital or expansion and the diversification, etc. Then the secondary market they are trading and thereby availing liquidity to the investors. So easily in the secondary market we are able to easily we can convert as a cash. Okay, then the price in the primary market it is the fixed price, but in the secondary market it's depends upon the demand and supply force, it may be fluctuating. Okay, it is a flexible one. A price in the primary market the price is fixed price because they are issuing the first time to the investors, and the secondary market it is depends on the demand and the supply force, based on that the fluctuating it will be there, so based on that the price it will change. Okay, then the next one is the presence. No organization setup here. In the primary market there is no organizational setup, but in the secondary market there is a geographical setup and the organizational presence. Then rules and regulations. So here the company is issuing the securities goes through a lot of regulations on the due diligence, because the company is issuing the first time to the investors. Yes or no? First time they are issuing to the companies. That's why they are following a lot of rules and regulations. The secondary market, the investor and the broker follows the rules set up by the exchange and the governing agencies. Okay, so based on the agency like a SEBI, they controlled, they gave a lot of guidelines. Based on the guidelines, we are able to buy and you can sell the securities. Okay, the next concept, classification of financial asset. So here the financial assets are classified two different types. So what is the meaning by financial asset? First of all, the financial asset is nothing but shares, securities, bonds, debentures, and bank deposit, provident funds, pension fund, national savings certificate, insurance policies. These all called as the financial assets. Yes or no? So in the financial assets are here classified majorly two types. One is the marketable asset and another one is the non-marketable asset. So what is that meaning of marketable asset? Marketable asset is nothing but which can be easily we are able to transfer to one person to another person. Which all the asset we are able to easily we can transferred from one person to another person without any much interference. That is called as the marketable asset. Say for example, I'm holding the 500 or 5000 equity shares of Reliance company. In that shares, if I would like to transfer to my brother, I can easily transfer. Okay, that is for example, the shares of listed companies, government securities, bonds of the public sector undertakings, etc. like that. These are all the examples for the marketable asset. We can transfer to one person to another person. Okay, then the next one, non-marketable asset. Here the non-marketable asset is opposite of the marketable asset. Here the assets cannot be transferred easily. We cannot transfer the asset from one person to another person. We cannot be transferable easily. Okay, that is called as the non-marketable assets. So look at here, we can say examples for the non-marketable assets like our bank deposit. Without my permission, nobody's cannot transfer to some other person. Yes or no? Then the provident fund, pension fund, national savings certificate, insurance policy, these are all the non-marketable assets. So the marketable securities, we can say the money market security, capital market securities, derivatives like treasury bills, dollars, option futures, fixed income securities, bonds, stock, these all we can say as the marketable assets. And the non-marketable is the bank deposit, provident fund, pension fund. Okay, and some insurance policies. These all we called as the chapter is over. Can you please recall once again the chapter number 4, Introduction to the Financial Markets? Meaning of financial market is nothing but in any marketplace where the buyer and seller participate in the trade of securities, equities. Okay, that is called as the financial market. Okay, then the next one, definition of financial market. It's nothing but the place where the people and organization wanting to borrow the money and brought together with those who are having the surplus funds. That is called as the financial market definition. Or we can say as the financial market, the market for creation and exchange of financial assets from the household savers to the business firms. Okay, then the scope of Indian financial market, I told you 3 major scopes. First one is the Financial market provides the financial assistance to the individual and organization, agriculture, all the sectors. Okay, then the second point, the financial market is giving the required fund on time. The financial market is giving the second point is nothing but the financial market, it gives the required funds on time to the all the sectors. Okay, then the third point, the financial market and the institution get the short term as well as the long term financial assistance. Okay, then the next types of financial market, there are five major types. Under that, all each type it is classified to different types. Okay, so first one is the on the basis of types of financial claim, two different parts. One is the debt market, equity market, and the maturity of financial claim, money market, capital market, and time of issue of financial claim, primary market, secondary market. Then the timing of delivery of financial claim, cash or spot market, and the forward or future market. Then the organizational structure, two parts. One is the exchange traded and another one is the over the counter. Okay, then the next one, role of financial market is nothing but the saving, mobilization, investment, national growth, entrepreneurial growth, and industrial development. This is the major role of the financial markets. Then the two different functions of the financial market, one is the intermediary function and the financial function. The intermediary function is nothing but transfer of resources, enhancing income, productivity usage, and capital formation, price determination, sale mechanism, and information. Then the functions of financial function, it's providing the loans to the borrowers, they are providing the funds to the borrowers, and another one is it's providing the assets, the returns to the lenders, and they are providing to the liquidity in the market so as facilitate trading of funds. Then the next one, the difference between the new issue market and the secondary market. The new issue market is nothing but where they are issuing the securities the first time. The initial issues market we called as the new issue market. The secondary market is nothing but resale market. The securities already they sold, they traded. Okay, so the resale market we called as the secondary market. Then the next one, the classification of financial assets is classified two parts. One is the marketable asset and another one is the non-marketable asset. The marketable asset, it means is nothing but the classification of financial assets. It's classified two different parts. One is the marketable asset and another one is the non-marketable asset. The marketable asset is nothing but which can be easily, the marketable assets which can be easily transferred to one person to another person, that is called as the marketable asset. Non-marketable is which some assets we cannot be transferred easily. That is called as the non-marketable asset.